Hi, everybody. Chris Englebert with Englebert Financial Advisors in Allentown, Pennsylvania. And fall is upon us. We have the October 2025 update. And what are we talking about now? We are talking about what is in the news ad nauseum, the government shutdown, and what does it mean? Now, I'm going to couch this in a different way, and I'm not going to get political about this, but really, if you remember a couple of months ago, I talked about the fact that they passed the big, beautiful bill. And I was a little disappointed in the big, beautiful bill because one of the things it did not focus on is it did not focus on the rate of change of government spending. Now, only in the United States, when we talk about cutting government spending, do we mean something totally different. If you or I cut our spending, that means we're not going to go out to dinner, we're not going to buy a new pair of shoes, we're going to cut what we spend. Cutting government spending has a totally different definition. What they mean by cutting government spending is cutting the rate of change of increase. And for the last couple of years, the rate of change of increase in government spending was approaching 5%. Well, the big, beautiful bill at first looked like it was going to cut the rate of change of government spending to about 2%. Instead, it cut it from about 5% to 3.5%, which is still a lot of government spending. Now, why am I talking about government spending? Because government spending has a direct correlation with inflation. If you remember 2 years ago, we had high inflation levels. The reason being is it was a lot of government spending going on out there. So one of the things that's happening right now with the government shutdown is that they're trying to pass a continuing resolution. And in that continuing resolution, they're trying to cut some of the rate of change of increase in government spending. How long the shutdown goes on, I have no idea. But if we look at history, we found that shutting down the government, unless it's for an unusually long period of time, 3 or 4 months, which I really don't think is going to happen, it really doesn't have any effect on the stock market. So let's talk about the stock market. The S&P 500 had its second best September going back over the last 27 years with a gain of 3.25%. The S&P 500 has risen 5 straight months. Now, if you remember over on the left side of our chart, this was back in April. This is when the tariff tantrum happened and the stock market rolled over about 21% in 6 weeks. We've recovered all that. We've grinded higher. The reason why we've gone higher is a couple of things. Earnings seem to be improving or have been good. Interest rates seem to be stabilizing, and it doesn't look like we're going into a recession anytime soon. Now, some of the labor statistics don't look that great, but what we're finding out is that a lot of those last 5 to 10% of a workforce that a company was kind of holding on to, those are the people that are being let go right now. So we're not seeing companies doing mass layoffs yet, but what's happening is that the layoffs they are doing seem to be helping earnings around the edges. So talking about interest rates, we had the Fed interest rate cut back in September. The 10-year tried to get below 4%. It dipped down. It floated back up. But if you look at the 2-year, the 2-year tells you where short-term interest rates are going. Right now, the 2-year Treasury is at about 3.5%. We got the 10-year Treasury a little bit over 4%. We're getting back to what we call a normal yield curve. So at the end of the year, I usually do my themes going in for 2026. And to give you a preview of one of those themes, one of my themes is going to be going back to a normal yield curve. So what does that mean? That means that short-term rates and long-term rates will not be the same. That's an abnormal yield curve. A normal yield curve is short-term interest rates are lower, long-term interest rates are higher. We're already beginning to see the yield curve act historically like it's supposed to be, unlike it has over the last couple of years. So just to sum it up then, we saw September at another 3.25%. We've had 5 months in a row. Again, we're talking about the point that we have a fully valued stock market, and the month of October has historically shown to be poor, so it could be challenging. I would not be surprised to see a 2%, possibly a 5% pullback at any time for any reason. Some people are trying to use the government shutdown as a reason to sell the stock market. One day this week, the market opened down about 200 points on the Dow, immediately recovered, and we went to all-time highs. So historically, the shutdowns in the stock market or shutdowns in the government have no effect in the stock market. But again, we're very fully valued as far as the S&P 500 goes and as far as the large cap stocks go. Again, to preview for next year, we've been on this theme of international stocks and small mid-cap stocks. We've actually seen small mid-cap stocks have a 2-month period of time, some of the best 2 months they've had in almost the last 10 years. We think that's going to be the theme as well. Going into 2026. So that's our September wrap up. Again, if you want to see this video, if you download my app by texting Chris E to 36260, what ends up happening is you can actually download my app and install it on your phone. And that way you can watch the videos. If you ever have any questions, give us a call. We're always available to answer and to review your portfolio as well. So let's see what the month of October brings besides scary stuff and pumpkin spice lattes. And we'll talk to you another month. Take care, everybody.